Hi, I'm Jeff Aronheim with CrossCountry Mortgage, and welcome to my YouTube channel. Today, we're going to walk you through what's called a loan estimate. The loan estimate is the initial estimate that's provided at the beginning of a transaction for a loan, and it's going to break down all of the fees and monthly payments. It is the money slide that tells you everything. These loan estimates are formal, regulated government forms that all lenders must use and follow. So it's great if you can read this one, you can read any of them. So what you'll first and foremost see is that this loan estimate is a 4-page document. The first page is a summary. The second page is a detail of the fees, and I'll go through those in more detail. The third page has some government required terms that are required to be disclosed, as well as some additional details about the loan type. And then the fourth page is just some information about places they can get services and support. So starting in the beginning, we have an example here, and you can see the company's name is going to be on there as well as the loan officer's information. I blanked out the client's names and property information, but you can see they're going to show that the date that it's issued, the sales price, and in the right-hand column up top there, this section here, it's going to give you some information on the terms of the loan. So in this case, you can see it's a 30-year amortization, it's a purchase, and it's a fixed rate conventional mortgage, and the rate is locked. You can see the rate lock is yes, and it'll tell you when it's locked until. If it says no, that means that the rate is currently floating and it can subject to change until you lock that rate. Moving down the first page, this is again the summary. It's going to show the loan amount, the interest rate, and the principal and interest payment. And then if any of these can change over the life of the loan, it will say yes to the right of them. You can see here they're all no, which means we have a safe vanilla 30-year fixed rate mortgage. They then have the projected payments, which has a breakdown of the principal and interest payment of the $2392.67, the mortgage insurance of $42 a month, and then the estimated escrow, which is usually taxes and homeowners insurance, of $228 a month. That total mortgage payment is $2663. Now, sometimes there are properties that have HOA, and this is exactly the case in this situation, where they summarize the estimated taxes, insurance, and assessment, which can stand for HOA. So this 535 that you see is the sum of the mortgage insurance, the estimated escrow, and the HOA. And to the right, you can see that this estimate includes those three items is checked. And then to the right of that, it says whether or not it's an escrow. So what this is saying is your taxes and insurance are an escrow, meaning it's part of your mortgage payment, but the HOA you're going to pay separately. To finish off this page, they have the estimated closing costs, that $14,300. It sounds high, but that includes a number of other items besides just the fees. And then the cash to close is the estimated money you have to bring to close to buy the home. That includes the down payment and the closing costs that are included. The second page is a detail of charges, and we're going to read the left-hand column and then to the right-hand column. So section A and B are more lender-related costs. The section A costs are the lender-specific fees. In this case, you can see a processing and underwriting fee. That's a very typical thing that you'll see. You'll also see additional items from other lenders that can show an admin fee, a lock fee, a setup fee. So those can vary a little bit, but they tend to be very similar in cost. The section B are lender-related fees that show the appraisal fee, credit report, and flood cert. Now in these cases, they may estimate slightly higher because we don't know what the actual cost will be. And you can see the credit report is much higher than what we typically expect to see. Same thing with the appraisal, that will often come in lower as well. Section C are the title service fees. And typically the seller will select the title company, and we just look it up, and whatever their fees are, there are. They don't really change much from servicer to servicer, but you can see the breakdown of a closing fee, the lender's title insurance, the settlement fee, and the tax-related service fee. The closing fee is for the loan closing fee, and the settlement fee is for the real estate closing fee, The lender's title insurance is to make sure that the home you're buying is free and clear of any liens. So this is there to protect you. And then a tax-related service fee is just kind of one of those simple junk fees you see. When you go to Section E, they have the taxes and government fees, which are pretty basic. There's the recording fee, which is basically the fee required to record your deed of trust with the county. You'll see anywhere from $170 to $200 is typical. And then the transfer tax is typically 0.01% of the purchase price. Now, if you go in resort communities, it can sometimes be 1% of the purchase price, which would be, instead of $50, it would be more like $5,000. The prepaid items are items that are not actual closing costs, but it's monies you have to come up with for closing. So in this case, you can see the homeowner's insurance premium. That is the insurance that protects your home from fires and damages, and basically homeowner's insurance. You have to pay the whole year's premium in advance. The second item is the prepaid interest, and what they're doing is they're collecting interest from the day of the month that you closed to the end of the month. Section G are the initial escrows that they're going to collect at closing. So the concept here is, think of this initial escrow as an initial account with an initial balance that they're establishing for the escrow account. And then every month when you make your mortgage payment, the lender's collecting a little bit of your taxes and insurance that are going to be due, 1/12 to be exact, and they're going to add that to that escrow account each month, so that when a year's gone by, they'll have collected enough to make next year's payment for you. So this escrow account, think it again as just an initial starting balance. The Section H, this is actually unique. This is a temporary buy-down subsidy. So this is actually paid by the seller. So those fees you saw that were so high of $14,000 is because the seller is paying $8,400 or $8,387 to do a temporary buy-down of the rate. You add all of that up, the total costs and the total closing costs, and that's how they get to the $14,308. Now down below is calculating the cash to close, and you can see we show the total closing cost of the $14,308. We add the $50,000, but then we're actually subtracting out that seller credit. So even though the closing cost showed $14,000, in this case it's really the difference between the $14,308 and the $8,387. And that's how they get your estimated cash to close of the $55,921. These first two pages are the most important pages. If you anything, these are the two you want to understand. But to get into the third and fourth page, they're going to just talk about comparisons. So the comparison section, they just say, hey, in 5 years, they're telling you this is how much money you're going to be shelling out over the course of 5 years. And of that $150,000, $21,000 of it will go towards principal. The rest is towards interest. The APR is a interest rate that factors in both the interest rate of the loan as well as the closing cost. So it's trying to express those two as a single interest rate over the life of the loan. I don't put a lot of credence into it. The government requires that we report this as well as the tip below. But in effect, it's an expression of the closing cost and interest rate in a single rate. I would tell you you're better off served knowing what are the costs, what's the actual interest rate that you're going to get. The APR is not the actual interest rate you pay. The total interest percentage is looking at how much interest, if you had the loan over all 30 years, in this case, what percentage of that principal balance would you pay towards interest? So that you can see, in this case, you're actually paying more than the principal balance over the life of the loan, almost 140%. If you had a 15-year fix, that number would be well below the 100%. The other items, they have the assumption. The assumption's really important. So what this is saying is you are not allowed to assume the loan. So when you go to sell your home, the next buyer cannot assume this loan. They have to pay your loan off and get the other one. All conventional loans are not assumable. Generally, the only assumable loans are going to be an FHA loan and a VA loan. They give you the requirements for home insurance, what happens if you have a late payment and when it is. It's just some standard boilerplate language about the acceptance and refinancing and servicing. We do explain that we do intend to transfer servicing of the loan. Most lenders do transfer service. We actually service loans, but because we use a third-party servicer, it's still a transfer even though it still says CrossCountry. The final section is just some additional details for services that you could shop for if you want to. Nothing you need to do. It's just simply there at information at your fingertips. So that's the summary of reviewing a loan estimate. If you have any questions, always feel free to call us, and be sure to follow our channel.